listening to the Decisive Podcast, insights and analysis to empower confident decision-making. Welcome to another episode of the Decisive Podcast. I'm your host, Kristen Hallam. In this episode, you're going to hear from Maxwell Clarke, a senior economist in our pricing and purchasing team at S&P Global Market Intelligence. Max is going to take us beyond the impact of tariffs on metals prices to see how U.S. trade policy is impacting costs for machinery and equipment. He'll discuss how the recent tariff policies, particularly in the U.S., are creating upward price pressures on machinery and equipment, while also examining the broader implications for global markets. Max also will unpack the weak demand outlook that is limiting further price escalation and the significant challenges posed by supply disruptions that have historically driven prices higher. He'll give us a closer look at specific categories, such as electrical machinery and construction equipment, and discuss the risks associated with parts categories that have seen substantial price increases. Max will also consider the uncertainty surrounding future tariff policies and their impact on business certainty. So gear up for an analysis on the key factors shaping the machinery market and what lies ahead for businesses and consumers alike.
Machinery and equipment categories themselves are, given how downstream we sit within these categories, are being impacted on a number of fronts. Obviously, they're being impacted by the tariffs being imposed on upstream commodities. There are also a numerous swath of tariffs being imposed on these items being imported directly. Obviously, the question we all have in our minds is, how bad will it get and when will it stop? The reality is, how bad will it get will in many respects depend on the overall outlook for demand, which is not good. For the most part, we're expecting over the remainder of 2025 and into 2026, see these tariff pressures in the US, for example, not just focusing on the US, make their way through prices. But beyond that, there's not a lot of sequential momentum to continue to move prices significantly higher from there. By that, unfortunately, unlike in the case of upstream commodities, it doesn't mean that we're going to be seeing declines. It just means that the year-on-year rates of escalation are going to fade back towards historic averages. We'll get back to that in a little while. But in general, supply disruptions that we've seen previously that provided significant continuous boosts to prices are not nearly the same problem that they were in the past. So at current demand levels, supply disruptions themselves are generally limited. Because of that, at the end of the day, like I said, we're going to see upward pressure in the US related to tariffs, but it's not necessarily going to play out. That same similar upward pressure is not going to be seen across the rest of the world. Here's the best kind of comparison that we can kind of give. Obviously, when we're talking about machinery, we have to paint with broad strokes given the number of possible elements that we could be incorporating here. And we're also doing it from 30,000 feet. So at the end of the day, the best that we can really do is look at these like top line indices. And more than anything, I think they're very illustrative of just like to what degree demand in general and the pricing environment across the rest of the world is incredibly weak. The reality is it would be very similar in the United States if not for tariffs. Because of that, all of this is essentially reflective of a bump that's going to be incorporating over the remainder of 2025 and into 2026. The upward pressure, the surcharge, the duty, the excess premium that importers are going to have to face and how they deliver it to market. But at the end of the day, their ability to continue that momentum is limited. So beyond 2026 or throughout the course of 2026, we see those pressures. Again, this is year-on-year rate of escalation, moving back down towards the trend line that was already previously established. It's not particularly shocking. But again, there are other ways to slice this apple. It's not just a question of US versus international. It does matter, obviously, because the US is facing a very different set of circumstances than the rest of the world. The rest of the world is facing a more difficult ability to get goods into the United States. And if you're in the United States, you're facing a much more difficult possibility or the reality that you're going to be paying more. Electrical machinery, for the most part, kind of woke up to tariffs and was almost probably given laughing to some extent with a little bit of gallows humor, given everything that the category is faced with respect to the shortages of electrical steel that have been going on for quite some time. In general, the greatest risk for that category and for any other category that you can think of within machinery, the greatest risk to move higher is something that would be in relatively short supply. But more than anything, that tends to fall into the categories of electrical equipment in general. Beyond that, beyond the impact of tariffs, beyond the impact of certain niche products, looking ahead, we don't know necessarily what the future for tariff policy will be. We can prognosticate all that we want, but the one thing that we do know more than anything is that the way in which this tariff policy has been rolled out, the way in which this tariff policy has been received, the way in which this tariff policy has been walked back, ultimately leaves a backdrop and an ultimate level of dampness for business certainty. At the end of the day, that uncertainty that projects might suddenly become significantly more expensive in the middle of them is something that is probably going to limit the ability for the economy to just move forward or to just get on with it. And so that's ultimately going to be holding back prices as well. It's not something that's automatically so readily able to be forecasted like something that's just so comfortably nested in a cost model. But the reality is, it's not something that just goes away. If we look more specifically at electrical machinery, these trends, these patterns, these themes are nothing new to anyone who's been paying attention for any amount of time. For transformers, you can say, haha, you have tariffs, we have lead times, and we've had them for quite some time. And so it's not necessarily something that's going to be able to significantly add to upward pricing pressure. At the end of the day, electrical machinery across all of these categories is probably, in many respects, quite close to that notion of demand destruction. If you're already having to wait 2 to 4 years for transformers and another 1.5 to 2 years for motors and generators, where do you really have to go from there? At the end of the day, material costs and material pressures and direct tariffs just add fuel to the fire. But the fire is already burning quite hot to begin with, so it's not necessarily something that can get substantially worse. That doesn't mean it gets better either. Not better in the sense that we're going to see prices decline, but it does mean that more than anything, the view that prices are closer to plateauing or moving back towards that more historic, typical level of escalation that we'd expect is a little bit more reasonable. Like I said before, we still have to get through the absorption of these tariffs, but beyond that, there's not a lot of momentum from the demand side of things that would allow secondary knock on effects to lead to sequentially higher prices from there. Question, obviously, this isn't just about the US. We might like to make it about us, but it doesn't always work out that way. We have interesting global comparisons. For transformers, we see here that, like I said before, the ability for additional gains is relatively limited. Similarly, for motors, this is the reflection of the absorption of tariffs, this bump that we're seeing over the 2025 to 2026 period in the US. And from there, we're expecting a resumed deceleration back towards plateauing, back towards flat growth or flatlining. I guess flat growth would be an oxymoron in a sense. And so more than anything, it doesn't really have a lot more to do or a lot more prices in this category do not have much more to gain. Looking at non-electrical, breaking back to a pretty broad concept or pretty broad concepts such as pumps and compressors, you're also similarly seeing the absorption of tariffs, but then again, resuming a decline back towards the prior trend that the series was pushing to before the announcement of these stricter policies or more restrictive policies. And like I said before, too, like not all categories are necessarily being impacted in the same way. The fans and blowers graph, for example, it's not really being hit by tariff policy or duties quite the same way as some of the other graphs that we saw before. The one thing that we do have to worry about are kind of more complex, bigger ticket items that we haven't potentially seen the full ramifications for. There's still more tariff absorption to happen, particularly for like industrial machinery. Just imagine your tractors, your construction equipment, your drilling and pumping equipment, and things like that. One of the things that we see, just for example, in the case of construction machinery, given the tendency for this category to see price increases at the beginning of the year, it hasn't quite seen the upward pressure that some of the other smaller ticket items probably would have seen. Obviously, some of that's reflective of weaker construction outlook and things like that. But one of the things that we did see, and I think more than anything, it provides an underlying layer of risk that really shouldn't be understated, is parts categories within this category, like a subcategory within construction machinery, which have essentially just exploded. We've already seen a realized 20% year on year increase as of the second quarter. Our projections, which are very easily realized, are probably for things topping out in the fourth quarter or the first quarter of next year above 35%, which is more than anything. I think the reality is almost like a death by a thousand cuts for purchases or things that you could potentially delay the purchase of a big ticket item, maybe when financing and the financing environment is more friendly. But at the same time, you're just going to have to pay more for the equipment that you have just to maintain it. And the reality of that is not too much is particularly friendly. We've also had, like I mentioned before, the uncertain environment with respect to tariff policy. What feels like it's not daily, but it almost feels like daily announcements of a wide swath of new tariffs coming down the pipe. And more recently, we've seen the expansion of 232 protections, 232 tariff policy towards a wide array of parts categories and fabrications that are only going to wind up impacting the outlook more significantly moving forward. The key takeaway in all of this for most categories is that tariffs exist, but the ultimate future for pricing and price escalation is going to come down to a weak demand environment. The ones that are in short supply, the ones that have extended lead times, those more than anything are the ones that possess the most upside risk. And that's really it. But beyond that, demand is fading and upward pressure is limited from here.
Thank you for listening to the Decisive Podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.